So two stories today, a macro one, a Canadian economy one, which seem to line up with some of the new data points that you guys have put together at Deloitte. What are you seeing?
Yeah, so globally we're seeing a slowdown, and today's numbers coming out of the U.S. with the ISM index dropping to the lowest level since June 2009 is yet another confirmation that the global manufacturing system is struggling. And it's in part a function of the fact there was going to be some natural slowing because the pace of growth was unsustainably fast. But then the slowdown was compounded by the USChina Trade war, the tariffs that have been applied, which didn't just impact those countries. It's actually fed through global supply chains. So if you weaken production and exports from a Chinese factory, they stop buying equipment from Japan that then doesn't buy equipment parts from Germany, and before you know it, it spreads around the world. And at the same time, we have Brexit uncertainty weighing on activity in Europe. So we have a lot of political risks that have actually been dampening global economic growth. And I think Canada won't be immune from it. I think that we're likely to see softer Canadian economic growth as we go forward. I think that the Canadian manufacturing sector has actually been outperforming others. But as the U.S. slows, I think that naturally you're going to see some moderation in Canadian manufacturing.
Yeah, we were having a conversation about this earlier in the program. I mean, how much of that potential slowdown in Canada comes from those faraway markets versus just ultimately coming straight through U.S. demand?
Well, it's going to be a combination of both, right? So if you have a global slowdown, that'll weigh on commodity prices, and Canada is a major commodity exporter. So, if for example China was to have a hard landing, Canada would certainly feel it, but it wouldn't come through the export channel as much as it would the commodity price channel. Whereas if you actually look at the Canadian economy, every single province does more north-south trade than it does east-west. And so our manufacturing system is actually integrated into a North American manufacturing system dominated by the United States. So, Canada will benefit from the stimulus that we're getting from central banks globally. That's one of the big shifts that we've seen this year. Heading into this year, most central banks were signaling tightening. Now they're actually easing. And the jury's still out whether the Bank of Canada will join them in cutting, but we're going to benefit indirectly from the fact that the Federal Reserve, for example, is easing policy, and other central banks are taking action to try and limit how weak the global economy becomes.
Well, it's interesting you say that because we've officially started the fourth quarter, and we were talking about fourth quarter stock performance last year, which was down significantly, but that was in that environment where we were talking about the new reality of higher interest rates, and boy, what a difference a year makes. So you mentioned the Bank of Canada. I get when they're trying to figure out what ultimately they're going to do, what are the sectors they're watching? I mean, even today in the GDP data, we highlighted some of that weakness coming out of oil and gas production. What are the sectors of the economy they'll be watching most closely?
Well, they're going to look at the most cyclical sectors, so things like the commodity sector and manufacturing, and they're going to be looking for signs to see if the global weakness is being drawn into Canada. The other thing, though, is, and this is the key issue from a global point of view, is we're already seeing global manufacturing isn't growing. Global merchandise trade is actually declining. Where we're seeing growth is in trade and services. The question is, will the weakness in manufacturing get to a point where it starts to infect services? Because that's where your recession risks actually pick up. So I think that the Bank of Canada is going to be closely watching global developments. It'll be closely watching the evolution of the risks here in Canada. And it's important to remember that Governor Poulos has said many times that he considers the conduct of monetary policy to be an exercise in risk management. So if we get good economic numbers, like we had very strong job data at the start of this month, that's the sort of thing that we'll say to the Bank of Canada, okay, well, let's wait and see. But if they start to see more signs that the Canadian economy is being affected by the global weakness, well, then the odds of them cutting rates increases. The one thing I'd stress, though, is if they cut rates, I think it's going to be a very small cut. Unless they see a recession taking place, I don't think they're going to use a lot of the limited ammunition they have. But they could join the club of central banks all leaning against the global slowdown. So, there's still a chance we could have a rate cut, probably not in October, but if the weak economic data starts to come in, then the odds of a December or a January cut go up.
What, just to extend that point a little bit, what about where the Canadian dollar ends up trading? The Bank of Canada's probably not going to say too much specifically about the loonie, but they do keep an eye on it, and certainly all this talk about rates can impact where the currency is trading. presumably a lower currency, not necessarily a bad thing for a manufacturing sector. How do you view the currency in this larger conversation?
Well, the fair value for the Canadian dollar, the exchange rate that equalizes unit labor costs in Canada versus the United States is about 82 cents. So anything below that is actually giving our manufacturers a competitive advantage. So we are getting stimulus from the exchange rate today. If the Fed continues to cut rates, and the Canadian dollar starts to rise because the interest rate differential is shifting in favor of the Canadian dollar, then I think the odds of the bank cutting rates actually increases. And it isn't because they target the exchange rate, as you said. What they're looking at is, if the Canadian dollar becomes less supportive to growth, then the output gap will be larger, inflation risks will be lower, and that warrants looser monetary policy.
Yeah. Just one quick question before you go. So I was saying earlier in the program, I was talking to an investment banker this week who said when they try to get deals going right now behind the scenes, it is very difficult for them because of the uncertainty, the headline risks. But we had a stock market watcher earlier who said, at the end of the day, stocks could continue to climb if, for example, President Trump makes more of an effort to get some of these trade headwinds out of the way. You're an economist, so you're looking at the numbers closely. If something more material were to happen on that front, would that alleviate some of the clouds that seem to be forming?
Absolutely. I think it's important to keep in mind that there are both upside and downside risks in the current environment. So, I think it's easy to look at the US-China trade dispute and say, well, we're going to see more tariffs applied in October, more applied in December. This is going to end badly. Well, equally, Trump actually has a very strong incentive to reach a trade deal with China before the presidential election. And it would be a huge coup for him. And if you look at what happened when we renegotiated NAFTA, it went, in his mind, it went from the worst trade deal in American history to the best trade deal in American history with almost nothing changing. So, he could certainly reach a trade agreement with China if he wanted to. And, just imagine how strong the stock market would be if that took place. Similarly, Brexit, which is a key risk, if we had a second referendum and the UK decided to stay, that would alleviate an enormous risk and actually provide big upside. Equally, the politics could bite us and actually cause a turn in the business cycle because the global economy now is very fragile.